Now to continue talking about the basics of common stocks, the security, let's continue here with part 2. First thing we want to kind of discuss a little bit about is dividends, right? What are they, right? It's one of the sources of income that you get when you invest in stocks. They're a return of profit from the company, and it's somewhat predictable, right? If you're an investor, you want some lower risk, you may want to invest in those companies that pay higher dividends, since you're fairly certain at least you're always going to get something. Current tax laws have dividend income at a fairly low rate. So now capital gains and dividend income are taxed at the exact same rate of return. So who makes this decision? Who decides to pay dividends? Dividends are decided by the board of directors. It's sort of incorrect to say that management decides how much dividends paid. It's really not the management of the company, it's the board of directors. So they determine if, when, and how much dividends will ultimately be paid. Now, of course, where do dividends come from? They come from profits. So the earnings per share of the company is a measurement of profit. Take the net profit after taxes, net income, subtract the preferred dividends that are paid, and divide that by the number of shares of common stock that are outstanding, gives us an idea of what the profit is per share for each share that's owned by the investor. So what are the things going to help us make this decision, right? What's out there that's going to sway the company one way or another to pay dividends? What are their growth opportunities? The more growth opportunities they have, the less they want to pay to investors in dividends so that they can purchase the assets for those growth opportunities. If they don't have a lot of cash, they may not be able to pay dividends at all. Possibly they have some contractual arrangements through loan agreements that may also limit how much dividends can be paid. But in general, there's also a question of how is the market going to perceive any dividend change or any increase or decrease in dividends, right? The firm has to justify that it's keeping this money, right? The money's not paying out as dividends, and it's providing a decent rate of return in the form of pricing. So if companies can't get the stock price to increase through investing in opportunities, then they should be giving that money to shareholders. And in the end, what is it that actually shareholders are expecting to get, right? The more they expect to get, if they don't receive those, it obviously has a negative impact on the stock price when shareholders are unsatisfied with what's happening. There's some dates that are important. The first date's the declaration date. They have to tell us that this is going to happen, that there's dividend going to be paid. So what do they tell me on this declaration date? The first thing they're going to tell me is what day is the check going to be paid. In this case, it's paid on the 30th of June. Who's going to get a check? Every investor who's in the stockholders book of investors is going to get paid if your name is in that book on June 18th. So if your name's not in that book, you will not receive a dividend. Now, there's actually another date. It's called the ex-dividend date. And this date is created so to take into account the fact that it takes time for your name to get into the book once you purchase a stock. So if you buy the stock on the 16th or 17th, even though you own the stock, it's your stock, you won't receive the dividend. But nonetheless, you're actually going to pay less for the stock. What happens is, we'll discuss that a little bit later, but what happens is the stock will reduce by the amount of the dividend. So if it's a $2 dividend and the stock price on the 15th was $35, the stock price on the 16th will be $33. So you don't get the dividend but you also paid less for it. So it's accounted for, if you will, even though you don't currently own the stock. There are two basic kinds of dividends. There's a cash dividend and a stock dividend. Obviously, cash is cash. A stock dividend is very similar to a stock split. That is, the dividend is paid out in the form of shares of stock. So this is, again, not as common as cash dividends are, but it is a way of obviously getting something to the investors. Now, of course, if you're getting a stock dividend, you're not getting cash. So stock dividends are not a taxable event, but cash dividends are taxable. So again, cash dividends are the most common form, and they tend to increase over time, typically keeping up maybe with inflation. What is the dividend yield? The dividend yield is a measure. It's a percentage. It's the rate of return that you're going to earn from receiving the dividends of the company. So if you take the annual dividends of the company per share and you divide it by the current price of the stock, that is the dividend yield. Dividend payout ratio represents the percentage of earnings that have been distributed in the form of dividends. So if you take the dividends per share divided by earnings per share, that tells you the percentage of profits that's been distributed. Now, 1 minus the dividend payout ratio is the retention ratio. What percentage of profits has been kept by the company? Again, we mentioned a little bit about stock dividends, right? You're going to be paid a dividend. A 10% stock dividend means you get 1 new share for every 10 shares that you earn. Again, they're not like cash dividends. They're not taxed until you actually sell the stock, right? So they're slightly different than a cash dividend would be. There are programs called dividend reinvestment plans. Essentially, when you buy into these companies, it's just a convenient way for you to accumulate capital. So instead of them paying you a dividend, they take your dividend and they purchase stock for you. So you're reinvesting in the company, which is compound earnings, which is a good idea to do. The only real challenge with this is that it is taxable income. So you don't receive any cash, but yet you're ultimately going to be taxed on this distribution. So it's a way to grow your investment in the company, to get a compound rate of return, but you ultimately still have to pay taxes on this dividend income. The next several sets of slides we're going to go through fairly quickly, but this is just talks about different types of stocks, right? Different ways you can categorize stocks, if you will. Blue chip stocks are basically large, well-known companies. Almost any company that you can name is a blue chip stock by definition because they're well-known. We typically find these on the Dow Jones Industrial Average. We'll talk about indexes throughout the course, but the Dow Jones Industrial Average is the 30 largest stocks in the domestic market. So by definition, they are large stocks. Now, not all are the same, right? As they mentioned here, there's AT&T, McDonald's, Pfizer, right? Some are a little bit more growth-oriented. Home Depot, Procter & Gamble, right? Walgreens, right? Blue chip stocks are typically less risky than other stocks. Why? Well, mostly because they're bigger, right? They're more involved in the economy. So they come and go with the economy as it comes and goes. So again, investors typically put their money in these because they get higher returns than bonds and they have a slightly less, at very less perceived, less rate of risk. What are income stocks? Well, by definition, they pay dividends, right? They usually have a higher dividend rate than other types of stocks. Now, this doesn't mean that they won't have price appreciation, But because most of the money or more money is paid to investors, there's less money for the company to invest. That means that there's going to be less growth opportunities for them to take advantage of. So they're going to have higher dividends. What's a growth stock? A growth stock typically pays very little, maybe even no dividends. These could be blue chip stocks, and they could also be very speculative stocks. So really we have to look at the type of stock that we're talking about. Typically they're more risky. They're more risky because they're typically looking at investing in things, looking for opportunities, taking risks with investors' money so that they can try to grow, right? So the appeal here is people are looking for price appreciation, but price appreciation comes at a risk, right? We want to make sure that we're purchasing things that ultimately may have some growth. Tech stocks are obviously riskier stocks. They're invested in the internet, invested in the computer industry, semiconductors, right? This can be a wide range. These could range from very speculative stocks and very small companies to very large blue chip stable companies. But again, the idea here is with technology, you're investing in something that has some risk. Speculative stocks are stocks that in general, we're looking for substantial price appreciation, but they really haven't shown us much growth. They haven't shown us much success yet. Maybe these are brand new companies, right? They have a brand new idea that just hasn't hit yet, right? So since they have a lack of a sustained track record, these are going to be perceived as being very uncertain, very unstable. These companies can start and grow to be mega companies. At one time, Microsoft and Apple were speculative stocks. They're not speculative anymore. They could grow to be big. They could grow to be non-existent. They could ultimately just disappear because they haven't been successful. So there's a lot of risk involved. Cyclical stocks. Again, when we talk about these stocks, they could be in one category or another, right? A cyclical stock could be a blue chip stock. A cyclical stock could be a growth stock. But cyclical stocks typically follow the business cycle. So in expansionary times, cyclical stock prices will rise, and in recessionary times, they're going to fall. Most of these are going to have something to do with manufacturing, right? The heavier the manufacturing, the more likely it's a cyclical stock. So again, these are things that maybe people might want to trade in and out of as they perceive changes in the economy coming around the corner. So again, cyclical stocks move with the market, right? They can be more sensitive, they can be less sensitive, but they move with the market. Defensive stocks, typically, they just don't move that much, right? They may move up and down with the market, but they're very less sensitive and susceptible to downswings. So defensive stocks are there. They just don't change that much. We see a lot of retail companies, a lot of restaurants, right? Public utilities, right? All of these are typically what we refer to as more defensive kinds of industries. They just don't change that much when the stock market changes. How else can we talk about stocks? We can also talk about stocks with respect to their size. And again, we'll go through these fairly quickly. A large cap of stock typically is from a company that has over $10 billion in money, right? Bigger is not necessarily better, but sometimes bigger is less risky. Mid-cap stocks, we're talking $2 billion to $10 billion, right? Again, a little bit smaller companies, there may be some price appreciation because they're a little bit less more risky, right? They don't really have long track records maybe, right? But again, if we're looking for some long-term growth, this might be a place that we would want to park some of our money. What about small cap stocks? Small cap stocks, obviously, they're very small, less than $2 billion. These are brand new kinds of companies. Sometimes you may hear people talk about emerging markets, right? Or emerging companies, emerging industries. They're brand new, they're very small. Lots of risk involved. Liquidity could be an issue, right? Might be difficult to buy and sell these at some times, but there's a potential for high rates of return. But as we continue to discuss, high rates of return can also bring us potential high risks. Can we invest in foreign stocks? Of course, the answers are absolutely, right? We can go for a long period of time. The stock returns in the United States have been, they say here, rather unremarkable rather than those up to the rest of the market, right? There are some attractive returns in the foreign world, right? Again, the U.S. share of the world equity, they here say about 40% now compared to 2/3 in 1970. So the domestic market is not that big a player anymore. So again, there are opportunities in foreign stocks in order to make some money. And if you look at where the United States here on the average stock returns, we're about 9.4% here from 1900 to 2014. And you can see that there are several companies, almost 10 maybe there, that have on average higher rates of return than we do. So there are opportunities for us to search in foreign markets. So how do we do that? We can do it through direct investment, right? We can actually go out and search through international economies, international stock markets, right? We need to be able to research in through those companies to find, or through those countries, to find companies that maybe have good potential for us. The challenge with this, quite frankly, is mostly logistical. We have to worry about currency. We have to worry about regulations, political environment, foreign economies, right? We have to worry about language barriers, right? How do you know, is the information available in English so that you can read it, right? So direct investment is a bit of a problem. So there might be some other ways that we possibly can invest internationally. Before we discuss those, though, I mean, how do you ultimately find the rate of return on a company that you purchase internationally? Well, obviously you have a current income. You're going to get some dividends. You're also going to get some capital gains, but you're also going to have to take into account that there could be profits and losses when changes in the economy change. So again, we have to look at the change of return that comes in dollars in that local currency, whatever it might be. Let's say it's euros. And then we have to add or subtract whatever rate of return we get from the US dollar and that particular rate of return. So that exchange rate, right, basically represents the change in value from that currency. So again, another way to calculate this, you find the ending value of the stock in the foreign currency, find out the dividends received in that foreign currency, and you find the return. This is just the holding period return in a foreign currency. You then multiply it by the exchange rate at the end of the holding period, divided by the exchange rate at the beginning of the holding period. This just represents the relative change in value in the currencies. And of course, subtract that from one, and you ultimately then get a rate of return. So, how does this affect us? A strong US dollar has a negative impact on foreign investment. If the dollar is more expensive, then people don't want to invest in the United States. A weaker US dollar has a positive impact on foreign investments. Foreign investments are going to look more reasonable, right? So you want to, if you want the value of a foreign stock and foreign currency to go up in your investment horizon, so you would like to see the value of both the company and the currency relative to the United States increase over time. So, changing gears just one more time. What are the types and uses of common stock? What would you want to use stock for? There's really only 3 reasons why you ever want to invest in anything, right? You may want to store value. You want to have a place that's safe, right? Stocks, by their definition, are a little riskier than other things, but maybe using high-quality blue chip stocks and not investing in speculative stocks. That might be a place where you could store some value. You may want to accumulate capital. Capital gains and dividends are going to help build wealth. So you can do that through growth stocks and income stocks. Maybe it's just a source of income, right? High yield, dependable companies that have dependable dividends might be a place that you could put your money on to get sources of income. So again, depending on my individual goals, that's going to determine what type of strategy I ultimately follow. What is it that I want from this investment goal? So the kinds of strategy we could have. We could have something called a buy and hold strategy. It's basic, it's very conservative. You find things that you would like, possibly some high quality stocks that offer some current income, they offer some capital gains, and you're going to hold them. Maybe you're going to hold them for 10 to 15 years. There'll be very little exchanging of these shares. You want to buy them and you want to let them ride, right? So investors here often might add to those stocks, but typically we're looking for stocks that we think are going to show a long-term opportunity for paying income, but also for having some type of price appreciation. If we're looking for current income, we're obviously going to be searching for companies that have increasing dividend yields. Do we want to see prices go up? Absolutely, but it's not going to be the primary importance in my investment strategy, right? This might be particularly good, especially when we think about retirement time. We might be looking for quality long-term growth. We're looking for capital appreciation. Lots of stocks may be traded in order to keep this process moving. But we're going to buy high-quality growth stocks. There'll be some mid-cap stocks, some tech stocks in there. We'll utilize the diversification that we've talked about in previous chapters in order to help spread our risk along. But the general idea here is a total return approach. We want to focus on investments that are going to give us high quality, that is dependable rates of return. And we're going to search for that to come in the form of both growing streams of income and growing streams of price appreciation. On the other hand, we may want to take an aggressive stock direction. We may want to try to find ways for us to take some extra risks, find those things. We probably don't want to put all of our really, what I would refer to as our good money, right? But maybe we have some money we don't mind losing that we want to take some gambles on. So we're really looking at capital gains, right? We're taking substantial risks. We may trade fairly frequently, right? The challenge, quite frankly, from my perspective in this case, is really not the risk of losing of value. It's that I'm going to have to spend a lot of time and effort to manage this, right? I may not have that type of flexibility in my life to work my way through this aggressive type of management. And even more aggressive is just speculative trading. Sometimes we refer to these people maybe as day traders, right? It's the highest risk. They're going to concentrate on very speculative stocks. Most of them, quite frankly, are going to be small cap stocks. Sometimes they refer to them as penny stocks. Most of the stocks play for less than $1. So they'll buy tens of thousands of shares, very little money actually invested, but they're looking for very small changes in these little unknown stocks, and that's what they're going to trade on. Again, just as with the aggressive strategy, this is very time consuming, and there's going to be a tremendous amount of transactions costs and taxes to be paid. In fact, if you're day trading and you're making money, your tax rate is higher than anybody else because your capital gains are going to be taxed at your ordinary tax rate, which means you could be paying a higher tax than a buy and hold strategy might hold for it. So that's the end of part 2. We're going to continue in the next chapter talking about some more about common stocks.